which was in 2008. I was covering the presidential election campaign on the campaign trail, and I was following John McCain, and it was June or July of 2008, and I was in Kenner, Louisiana, and McCain was giving a speech. Does everybody remember the whole drill, baby, drill routine that McCain did? This was in response to the skyrocketing gas prices of that summer. If everybody remembers, gas went through the roof in 2008. Oil actually went up to as high as $147 a barrel, and both parties were scrambling to make political hay out of this issue. John McCain was saying, of course, that the problem was that we weren't drilling enough in Alaska and the Gulf of Mexico, and the explanation on the other side was that, according to Barack Obama, was that we were consuming too much oil, and that Americans needed to drive hybrid cars, and so on and so on. So McCain gives the speech, and then after the speech, all the press were filing into the plane/cage, the press section, and the reporters who always, that's sort of the national sport, is to pick on the candidates behind their back. One of the television reporters was sort of busting on McCain, essentially saying, what an idiot, as if the failure to drill in the Gulf of Mexico was causing this skyrocket rise in gas prices. And I kind of raised my hand and I said, do we actually know what's causing the rise in gas prices? And it was like straight out of a cartoon with the crickets, Literally nobody had an answer. I didn't have an answer. And then so I turned to one of the reporters next to me, and I'm like, doesn't that make us all frauds since we're writing about this stuff? And he said, you're only just figuring that out now? So I was very troubled by this. Obviously, it's the duty of every good paying journalist in the country to act like an expert on things he knows actually nothing about. But even in this case, I was, despite that, the fact that I was normally comfortable doing that, in this case, I was very, very unnerved by the fact that I didn't know what was causing this rise in gas prices. So I started to make some telephone calls, and one of the first things I did is I called some commodities traders, and I spoke to a Saudi gentleman who right away explained to me a very interesting fact, which was that international oil supply was actually up that year in 2008, and in the first half of 2008, demand for petroleum in the United States was actually down. So he says to me, by logically speaking, prices in America should be going down. And I said, well, then why are they going up? And he said, oh, how much time do you have? And this led me to this whole investigation of how the commodities market works, and this is a very complicated thing. And he referred me to some people on the Hill in Washington who led me through this whole history that begins with a law we passed in the 30s called the Commodity Exchange Act, which basically outlined the structure of how commodities like oil futures and gold and silver and soy and corn and wheat, how all these things are traded. And one of the key rules is that they very tightly regulated the amount of speculative money that was allowed to be on this market. Most of the people who buy and sell commodities, these needful, necessary commodities like wheat and corn and oil, you have to be what they call physical hedgers. In other words, you were physically either producing or consuming those commodities. They only had a very small number of people who were allowed to be speculators, and there was an obvious reason for this. You didn't want a speculator coming in, buying up the entire corn market, and then artificially jacking up the prices on everybody. You wanted to make sure that the prices of commodities more or less accurately reflected what their real value was to the people who consumed and made them, and produced them, excuse me. So for 5 or 6 decades, we had this tightly regulated system that worked more or less perfectly. And then in the early 90s, some companies, particularly some investment banks, quietly started applying to the government, and in particular to the Commodity Futures Trading Commission, which is the executive branch body that oversees commodities. They applied to them for exemptions. The first one was Goldman Sachs through its subsidiary J. Aron, and they applied to the CFTC, and they basically said that we're tired of being considered a speculator. We would like permission, please, if you could, to treat us as a physical hedger. And the CFTC quietly wrote them a letter giving them this exemption. Over the next 10 or 15 years, the CFTC then went on to give out 15, 16, 17 of these exemptions, All the major investment banks have them now. And this resulted in an explosion of speculative money on the commodities market. In 2003, there was only $13 billion of speculative money in the commodities market. By 2007, there was over $300 billion of speculative money on the commodities market. Now, why did this matter? Unlike the stock exchange, where you can bet on or against stocks, in other words, you have what they call long or short bets. If you're long on something, if you're long on IBM, for instance, that means you're betting on the stock to go up. You can short also IBM. You can bet on to go down. In commodities, all money is basically long money. If you're investing in commodities, you are investing in the price of that commodity to go up. So why was there suddenly $300 billion of speculative long money in the commodities market? Well, it had a very simple explanation. In 2007, the mortgage bubble started to blow up, and I'm going to get to what that was all about in a second. And the investment banks, the same ones who had originally marketed the mortgage-backed securities as such a good idea to all their clients, they suddenly turned to the pension funds and insurance companies and other huge institutional investors who were their clients and said, well, you need to get out of this risky mortgage stuff and get into something that's safe. And what could be safer than gold and wheat and soybeans and corn and all this stuff that people are always going to buy because they always need it? So suddenly there was an explosion of speculative money into the commodities market, and voila, we had a situation where the price of gas went through the roof, and in 2008, again, there was over $300 billion of speculative money, and oil reached $147 a barrel. And some of the banks actually said it was going to go higher than that. Goldman Sachs actually was predicting that oil would reach as high as $200 a barrel. So there was this incredible mania for driving people into buying gold and silver and oil, and that's what caused this price rise. Now, the other amazing thing about this is that it wasn't just oil. When I went back and talked to that Saudi guy at the end of this whole process, he sort of mentioned to me parenthetically that, oh, by the way, in addition to oil going up to $147 a barrel, 100 million people around the world, according to the WHO, joined the ranks of the hungry in 2008, mainly because food prices also went through the roof because all of these commodities are traded in the same index. Most of the people who are actually buying oil futures are doing what they call commodity index speculation. In other words, it's kind of like a mutual fund for commodities. You go in and you buy packets of commodities, so not just oil, but all those other things I mentioned, wheat, agricultural products, which is why between 2003 and 2007, all 25 commodities on the Goldman Sachs Commodities Index, which is where most of this trading is done, they all individually each year rose. And the average price hike for each one of these commodities was 200%. Amazingly, the amazing thing about this, again, this all goes back to these secret private exemptions that all these banks got to trade on the commodities market. And when I talked to an aide to Bart Stupak, who was at the time was the head of the House Agriculture Committee, which had purview over all this, he told me this incredible story. They only found out about these exemptions by accident, and it was in the middle of 2005. The House Ag Committee was having a meeting with some officials from the CFTC, and one of them happened to mention, oh, by the way, we've been handing out these exemptions since 1991. And the guy says, this aide says, really? You've been handing out these exemptions? Can I see one? And this is actually true. The CFTC official said, no, wait, I have to check with Goldman first. They literally had to check with the banks before they could deliver these copies of these exemptions to the House Agriculture Committee, which just goes to show the extent to which these regulatory bodies are completely captured by industry. Now, there are two aspects of the story that are kind of important and are kind of constant themes in my book. One is that this arrangement, these secret exemptions, constituted a kind of ongoing, indirect, actually not even indirect, a direct government subsidy. And why is that? If any of us in this room want to go and buy oil futures, we can't just go and do it. We have to go to one of these companies that owns one of these exemptions from the government, and they have the permission to go and buy oil futures for us. So every time anybody buys commodities or invests in commodities, they have to go through this official government middleman and the banks always get their cut, and it's basically free money. They don't have to compete for it at all. This is a constant theme of modern Wall Street, is that all these banks have managed to arrange in every corner of the financial universe a system by which they have official middleman status or some kind of protected status that allows them to get in between necessary transactions so that they always get a cut. Another great example is the primary dealers for the Federal Reserve. If you and I want to, for instance, buy U.S. Treasuries, we can't just go and officially do it from the Fed. We have to buy them through one of these banks that is an official registered primary dealer for the Federal Reserve. Most of these banks right now are the federal interest rates. The interest rates for the Fed are close to zero. They're lending out money essentially for free. But if any of us want to go get a mortgage or take out credit card debt or lease an aircraft or anything, we can't just go to the government and get that 0% interest rate. We have to go to a bank that is an official bank holding company and has that official status, and are allowed to go to the Fed's discount window and borrow at 0%. So instead of us directly borrowing from the government at zero, we go through a bank which itself borrows from zero, and we borrow from the bank at 5 or 6 or 15 or 20, or depending on how bad your credit score is and how much interest rate you're paying. So this is a persistent theme of the book, is that there are these subsidies that exist everywhere. The other thing about this commodities rise in 2008 is that it was a speculative bubble. This was bubble economics. And what is a bubble? It's really just another fancy word for a Ponzi scheme. And does everybody here know what a Ponzi scheme is? It was invented right here in the great city of Boston. Ponzi scheme is just, it's a fraud scheme by which a whole bunch of people are invited to come in and invest in some kind of overinflated asset, and they're promised extremely high rates of return sometime in the future. And the way Ponzi schemes work is that everybody is fine so long as there's more money coming in than there are people cashing out. As long as there's more money coming in than there are people cashing out, they always have enough money to pay off the old investors with the new investors, with the money from the new investors. But as soon as people start cashing out, eventually the bottom falls out in the value of the asset, and everybody loses except the people who are actually doing the scheme, who've been taking out fees and services and bonuses the entire time. That's the way a traditional Ponzi scheme works. Somebody comes to you and says, hey, if you invest $10 in my fund, I promise I'll give you 20 in a year. And they do that to enough people, and at the end of the year, they're already off living in an island somewhere with your proceeds, and everybody is sort of left holding the bag. Well, that's what the commodities bubble was in 2008. It was all these banks were essentially telling people that the price of commodities was going to continue going through the roof. Everybody rushed in, institutional investors, pension funds, and of course, gas was never really worth, or oil was never really worth $147 a barrel. It was, true value was probably closer to 40 or 50, but they churned everybody for fees and took out bonuses during the meantime, and when it all collapsed, everybody was left holding the bag, but they actually kept their money. That's the way bubble economics works, and it's been going on over and over and over again, not just in commodities, but in many different sectors of the economy. And which leads me to the next thing, which is mortgages. And obviously the mortgage bubble was the key thing that led to the entire financial crisis. And it's very, very complicated. But after 2 years of covering this, I've finally, I think, reached the point where I can explain this in relatively simple terms. How many people here have ever smoked marijuana? It's funny, just one person admitting, right? Because it's professors are here. That's hilarious. Well, I've smoked marijuana, and all the mortgage crisis is banks selling oregano as weed. That's all it is. The actual mechanism by which they do that is really, really complicated, but when you get right down to it, all it is taking something worthless and selling it as something that's worthwhile. Now, how did they do that? Ages ago, when you took out a mortgage in the 60s, 70s, even the 80s, you were borrowing from a local bank or a credit union that actually cared if you had a job or were a citizen or had identification or existed, because they were going to hold on to that loan. The entire economic value of that transaction for them was betting on whether or not you were a good credit risk over the next 15 or 30 years. They were not going to give a loan to an unemployed meth addict because that person was a bad credit risk. So what changed? Two things changed. One of the first thing was they invented this technique called securitization, which actually goes back to the 70s. And securitization is just a process by which you take a whole bunch of assets like loans, you put them in a big bucket, and you chop them up and make securities out of them. That's the first thing. And the second thing was they invented derivative instruments like CDOs and CMOs. Everybody here heard of collateralized debt obligations or collateralized? Okay, a few. Basically, these were fancy mathematical instruments, and here's how they worked. You take a giant pool of subprime loans. Let's just assume that everybody in a pool of 500 or 1,000 loans is actually a low-income, high-risk borrower with poor credit scores who is a bad credit risk. And you take all of those 1,000 loans and you throw them in a big bucket, and you chop them up into little pieces so you can sell them individually as securities to people. And what they did is they kind of applied, with these derivatives, they applied a sort of magic wand to the whole bucket and did this hocus-pocus math by which they essentially said, well, 99.9% of the time, 26% of these loans are never going to fail. Or we're going to get 26%, at least 26% of the money that's owed into this bucket every month. So let's peel off that 26% part and sell that as a AAA-rated security to some trade union in Iceland or a German land bank or the state pension fund in Massachusetts or an insurance company. And by that magical process, you take crappy loans that really are not only not AAA, they're not even B, they're actually C-rated or what they call junk-rated loans, and they apply this math to them, and they'll get a portion of it that's actually AAA. So again, you're taking these big masses of loans and you peel off the AA part and you sell it off to somebody else. Once they perfected this technique, once they figured out that they could somehow turn oregano into weed, then the deal was basically done. Now the incentive was, let's make as many of these loans as possible. And the instant that they're closed, here's how this worked. The big banks like Goldman Sachs, they knew they had customers who would buy these AAA-rated portions. They went out into the world and they said, hey, Iceland, or hey, German land bank, are you interested in AAA-rated paper that pays 6.5% a month, which is twice what, for instance, a U.S. Treasury bond pays, or a type of Treasury bond. And of course, they're going to say yes. A lot of banks and a lot of companies are mandated. They have to keep a certain amount of AAA-rated investments in their portfolios according to law. So why not get a AAA-rated investment that pays twice as much as the usual kind of investment? And all these banks were offering everybody around the world this amazing new AAA-rated vehicle that paid much more than the traditional investment. So they had these buyers. They knew they had these buyers. And so they essentially sent out memoranda to the entire mortgage lending universe that, hey, we'll take as many of these loans as you can write. It doesn't matter who they are. It doesn't matter whether they exist or have jobs or ID. Who cares? We're going to put it all into a big basket. We're going to chop it up, wave the magic wand over it, and sell it off to somebody. So go forth and lend. And at the height of this boom, I actually talked to somebody who worked for a company called that was like Countrywide. They were literally going out in the middle of the night, these mortgage lenders, and going to 7-Elevens and looking for indigent people they could lend mortgages to because they knew they had a market for this stuff. And in the rush to bring all this stuff to market, they committed every kind of fraud conceivable. These mortgage lenders, like Countrywide, they faked credit scores. They wrote that people had jobs when they didn't. They inflated appraisals. There were all these scams. The appraisal inflating scam was a very typical one where the mortgage lender would send the homeowner to an appraiser, and the appraiser would come back to them and say, wow, actually this house isn't worth the $280 that it's listed. It's actually worth $350,000. and the homeowner would get all glum and start to walk away, and the lender would come in and say, no, don't worry, we'll lend you the extra $70,000 that you need to buy this house. And voila, the appraiser and the mortgage lender would then split the extra commissions that they got from that extra money that they were lending. So as soon as they got these people signing the dotted line, and it just didn't matter who it was, as long as they had a pulse, the instant those deals were closed, if you bought a house, the moment you closed on your house, it was sold off. Your mortgage was sold off to one of these big banks like Goldman or HSBC or JP Morgan, who in turn, within 90 days, were usually selling it off to some investor. So it was a hot potato game. Nobody was actually worried about who the credit risk was because they knew the end game was actually this fraud scheme. So what ended up happening in the end? This is where AIG comes in. This is the sort of a truly amazing, disgusting part of the story. Some of the banks, and Goldman in particular, started to realize, hey, it turns out that if we're lending billions and billions of dollars of essentially fraudulent loans out into the marketplace, eventually there's going to be a correction somewhere. All this stuff is going to blow up, and somebody's going to get hurt very badly. So I know what we can do. Let's bet against this stuff at the same time that we're actually creating it and selling it out in the marketplace, because we know it's crap, and so why not bet against it? We know it's going to blow up. The only problem was they had a bit of a conundrum, which was who would be dumb enough to take a bet on billions and billions of dollars worth of toxic mortgage-backed securities. And that's where AIG came in. It was this one lone lunatic in a unit of AIG called AIG Financial Products that essentially wrote $500 billion worth of bets on the mortgage market. He took all this action from banks like Goldman Sachs and Deutsche Bank and Societe Generale that were trying to bet against the very stuff they were selling. AIG was the bookie that was taking all those bets. And there's a big philosophical question on Wall Street. Was Joe Cassano, the guy who wrote all these bets on Wall Street for AIG, was he stupid or was he corrupt? And because here's the question. Even though he blew up his company and nearly blew up the universe by writing $500 billion of bets that he couldn't cover. Now, again, remember, just to back up for a second, because of laws that we passed in the year 2000, AIG did not have to have even a dollar to back up any of those $500 billion of bets. In an ordinary casino, the house actually has to have money to cover a bet if you go to a roulette table. But in Wall Street, you don't. You don't have to have even a dime. So he blew up his company making this enormous bet. But he himself made $300 million in bonuses during the period covered by the crisis, and he hasn't had to give back even a dollar of that money, and he's not going to jail, and he's still living in a fancy townhouse in London. So was he stupid, or did he just not care, is kind of the question. And a lot of people that I talk to are sort of the opinion that he just didn't care. It all worked out great for him in the end. So you have this incredible confluence of con men. Everybody's conning everybody else, and at the end game with AIG, you had all these banks that were chuckling to themselves thinking, oh, wow, we found the sucker in the room. Here's AIG that's going to take all this action. Whereas, in fact, the guy who was running AIG was himself conning, not the banks, but actually his superiors, writing all these bets that he never intended to pay off. So what happened in the end? Of course, AIG was insolvent. They were not able to pay off these bets once all these mortgages started to blow up. So that was the moment in time when all the banks who had made these gambles with AIG suddenly got together and they ran to the U.S. Treasury, and Henry Paulson, the Treasury Secretary, who of course was a former head of Goldman Sachs, and they said, this will not stand. We made billions and billions of dollars of bets with AIG against the very properties that we're selling. We were selling to people, and AIG is now claiming they can't pay. How is that fair? So in the end, the government decided to do a $180 billion bailout of AIG to pay off these gambling debts. And the end game of this is so amazing when you think about it. It's banks like Goldman, Societe Generale, and Deutsche Bank, an American, a French, and a German bank running to the United States government to get them to pay off the gambling debts of a British insurance company with $180 billion. And that's kind of what happened in the end. And the other thing that's amazing about this whole thing is just the pervasive consistency of the approach of everybody from the very bottom part of of this whole sequence to the very top. At the very bottom, you had individual lenders who were faking credit scores and telling people who qualified for 30-year fixed loans that they should get into much, much riskier option adjustable ARM loans. People who inflated the appraisals. The appraisers were corrupt. Of course, the lenders like Countrywide were completely corrupt. They knew that they were selling stuff that had not been properly researched. In fact, there was recent testimony on the Hill that up to 50% of the loans that companies like Countrywide lent out did not meet normal underwriting standards. So those guys were crooks. The banks that bundled this stuff up and then sold it off to Iceland and Sweden and all those places, knowing that it was toxic, they were crooks. The ratings agencies who gave this stuff AAA ratings, most of those companies were financially dependent upon the very banks that they were giving the ratings for. They were crooked. You had hedge fund speculators, people like John Paulson. I don't know how many people have heard about this case involving Goldman last year, but there was a case where this hedge fund billionaire, John Paulson, actually went to Goldman and said they ran out of real people to bet against. There weren't enough real loans, crappy loans out there for him to bet against. And so he went to Goldman and asked them to create a synthetic package of crappy home loans. He basically said, let's make the worst batch of synthetic home loans that we can, and then let's go and sell it to ABN AMRO, which is a Dutch bank overseas, as though it's a good investment. So they were intentionally making bad investments and dumping it off on people and then betting against it. So the hedge fund guys were crooked. The guys like Joe Cassano at AIG, who were rating all these bets without ever intending to pay them off, they were crooked. None of this whole bubble would ever have happened if anywhere along the line anybody had even a modicum of normal human decency or ethics. And the amazing thing is that this behavior was consistent, not just in a few companies and not just in a few places, but literally everywhere at every single one of these companies. And that's how we ended up getting into this mess. Anyway, on that cheery note, that's basically sort of what this book is all about. It's kind of, in a way, it's a true crime book that really goes into the details of how these elaborate scams worked. It's both depressing but also really, really fascinating to me personally. And if you like crime stories, I think you'll enjoy this. And anyway, thank you so much for coming. And I guess we'll take some questions if anybody wants to ask. Yes, sir.
Why isn't anybody going to go to jail?
It's a really good question. The only person who's gone to jail, of course, is Bernie Madoff, right? And Bernie Madoff was definitely engaged in a typical Ponzi scheme. He promised investors that he was going to give them impossibly high rates of return, and of course, there really never was any investment. He was just getting money from people and paying off the old investors with the new. But the amazing thing about the Madoff deal was every single one of these real estate trusts was a little Madoff. That's all they were. And whenever these banks got together these bundles of mortgage-backed securities and then sold them off at higher rates to foreign investors, that was exactly the same scam as Bernie Madoff, and it was replicated hundreds, thousands of times over, and nobody's going to jail. And there was just, I think, a policy decision in both the Bush and the Obama governments that we are not going to criminally prosecute any of this, despite the fact that it clearly was criminal fraud.
Will the recently passed legislation limit any of this?
A good question. The Dodd-Frank Act that was passed this summer, the short answer is no. Really, there were a couple of good things in that bill, but the main problems here weren't really addressed. No, the key thing, of course, is the whole too big to fail issue. These banks have gotten so impossibly large and concentrated that when they behave irresponsibly, we have to come in and rescue them, which is what happened in 2008. AIG, we had to come in and rescue. I think there was an argument that we didn't have to pay off those particular gambling debts, but we had to rescue the company. They did nothing to fix that problem. They haven't really done anything with derivatives, which were, of course, a key in this whole thing. So it's not a good situation. The one thing they did do was pass this thing called the Volcker Rule, which ostensibly prohibits federally insured banks from engaging in risky behavior, but the Republicans have just promised to repeal that. So I think that's going to have a short shelf life, too. Yeah. Yes, ma'am.
How does lack of regulation or deregulation factor in? And it sounds like what you described started in the early 90s.
Mm-hmm.
And my memory is that deregulation came later than that.
No, it actually started, it's a good question. The two major deregulatory acts were the repeal of the Glass-Steagall Act, which took place in 1998. And the Glass-Steagall Act was something we passed in the 30s, which prevented the merger of insurance companies, commercial banks, and investment banks. Without the repeal of that act, we couldn't have had these too big to fail companies. And that law was passed specifically to make legal an illegal merger of Citigroup, which Citibank, Travelers Insurance, and Salomon Brothers had merged in 1997 illegally, and they needed to make it legal, so they got their buddies in the Clinton White House to pass a law legalizing it. The second one was the Commodity Futures Modernization Act of 2000, which basically deregulated all these derivative instruments, the ones with that magic wand, math, among other things, saying that banks didn't have to have any capital to back up any of these bets. The other thing that was amazing about that particular law is that all this stuff is so exactly like gambling that they had to actually put a section in the bill that specifically exempted the banks from state gambling laws because otherwise, the credit default swaps, the things that AIG were doing, they're no different from gambling. They needed that exemption in order to operate legally. So that was when it all started. Yes, sir.
Whenever this topic is discussed, there's always a claim that I was just stupid. Well, it seems to me like everyone there was very smart.
Mm-hmm.
Maybe they had to give back $10 million out of their $100 million they stole.
Mm-hmm.
So it sounds like it's actually a good career choice for all the students here.
Yeah.
You too can be a crook.
Right.
Make $100 million, and you might be fined $10 million.
Yeah, absolutely. And look at Angelo Mozillo, the head of Countrywide. Now, Countrywide was basically openly a criminal enterprise. I mean, these guys were straight out of The Sopranos. These guys, they were literally giving loans to anybody who was walking by their office, and they just did not care at all. They created this massive mountain of debt. They were absolutely the worst people in this entire story. And the head of Countrywide, Angelo Mozillo, was just given the sternest punishment handed out to anybody, any individual in this entire crisis. He had to pay a $50 million fine, which would be stiff, except that he made over $300 million during this time, and that he still gets to keep that money. So even if you're the absolute worst guy and the poster child for all this stuff, it's still a good career move for you to steal all this money. Yes, sir.
Do certain news venues shun you? Because I've often wondered, how come you haven't been on Charlie Rose? I've often wondered, there's a lot of news talking heads, and I've never seen you. Do they not want to talk to you, or?
I do a lot of television. I'm on MSNBC a lot, and there are some shows, some cable shows that I go on. But in the financial universe, it's a very incestuous community. I think that there was a lot of resentment, not just towards me, but to some other reporters who were outsiders who came into the financial story, people like Joe Hagan at New York Magazine. And there's a sort of idea that financial reporting is for people on Wall Street. They specifically, it's kind of like ESPN. ESPN isn't for people who don't know football. They don't have to they don't have to explain the rules of football every time they do NFL primetime. And that's kind of the way financial reporters see their jobs. They hate the idea that they have to explain all this stuff to all of us every time they write about this. And I think they viewed me and some of these other guys as sort of unwelcome trespassers, and that's one of the reasons that we've been frozen out, I think, a little bit from that whole world. Yes, sir.
Obviously, the old axiom says they're going to steal big,
Right.
But of the money that the government lends out,
Has anything been paid back? I know it's been paid back, but they say all of it has been paid back. How much of it has really been paid back?
Well, when they say that, what they're talking about is the TARP, the Troubled Asset Relief Program, which is a $700 billion bailout program, and pretty much all of that money has been paid back. The only problem is the TARP was only about a 20th or a 30th of the entire bailout. Most of the bailout came in guarantees or indirect loans. You know, for instance, that scheme that I outlined before, where the bank would borrow from the Fed at zero, and then lend. They'd actually borrow from the Fed at 0% interest rates, and then they would lend the money back to the government at 3% interest rates. They always say that, we deserve to make all this money because we're so smart. We're the smartest guys in the room, and nobody else can do this job as well as we can. But you don't need to be a genius to borrow from the government at 3 and lend back to the government. Borrow from the government at 0 and lend back to the government at 3. That's just like parking an ATM machine up to the side of the Federal Reserve. None of that money's been paid back, and in fact, most of the if you've noticed, a lot of the banks had these huge bonus pools in the last couple of years, despite the fact that they were all functionally insolvent in September of 2008. All that money is state money. That money all came from you and I, the taxpayer, and it's never going to get paid back. And they're making a lot of hay out of the fact that they paid off that one chunk of it, but that's really minor. Yes, sir.
Do you think it's still a house of cards, and if so, how can individuals protect themselves from the house of cards?
That's a really good question. It is, on some level, still a house of cards. I was just in a foreclosure court in Jacksonville, Florida, where I watched dozens of foreclosure cases, and every single one of them involved phony paperwork. The essence of what's going on right now, all these banks and also the Federal Reserve, they all still have billions and billions of dollars of these mortgage-backed securities on their books. And they're all listing them at par. They're all listing them at face value. So if they're saying the loan is worth, 100 cents in the dollar, in reality, most of these mortgage-backed securities are now probably worth 5 or 10 cents in the dollar. And so there's a long way down for this stuff to go. We're just pretending that those losses haven't happened yet. Now, eventually, some of these loans, these securities are going to mature, and people are going to find out that they're not really worth anything, and we're going to have another enormous correction. A lot of the government policies that are being instituted right now are designed to forestall that inevitability. Like, has anyone heard of this quantitative easing program that happened a few weeks ago? The government just printed $600 billion out of thin air. They did like an I Dream of Jeannie thing and just invented a whole bunch of money. And that money is going to buy T-bills, but also mortgages. They're creating artificially a market for this stuff so that it doesn't collapse. So what can people do? I mean, I have an IRA. I instructed my guy to get out of anything that has mortgages in it. I'm rushing into safe stuff like Treasury bonds, and for the time being, because there's just so much stuff that's risky out there right now. The typical thing is to go into gold, but gold is also a commodity, so that's scary. I would go with truly safe stuff. Government debt is what I'm doing. I can't believe I'm giving investment advice, but yeah, that's just a couple more probably. Yes, ma'am.
When you were doing all this research, I've read a lot of the stuff online from various newsletters, and actually one of them was a former Northeastern business professor. And you talked about the fact that we had to bail them out, but if we're a capitalist society, why should we have bailed them out? If they made bad investments, they should have had to just go belly up and move on. The other side of that is a lot of this information is camouflaged in the complication of it.
Mm-hmm.
You don't get to know. And the Federal Reserve Bank, which is not part of the government,
Right.
is really at the base of all this. And did you find that the Federal Reserve Bank was really...
Sure, yeah. The second chapter of my book is all about the Fed, and this couldn't have happened without the Fed. Every time these guys engaged in these bubble schemes, and this goes back, 10, 20 years. The internet stock bubble, was a classic bubble. The mortgages, commodities. The 87 stock crash wasn't a bubble, but it was a derivative-based disaster. Every time they did something irresponsible, the Fed would slash interest rates to zero, which essentially allowed these guys to do what they call drink themselves sober. They would borrow a whole bunch of money for free and then get themselves out of trouble again. they would not have been able to do that without the Fed. And they, in fact, they had a word for it. They called it the Greenspan put, which is complicated. But the idea here is they always knew that the Fed was going to be there to rescue them, which encouraged them to behave recklessly because they knew that there would never be any consequences. Now, on the issue of whether or not we had to bail them out, that question's like a little bit above my pay grade. I mean, that's a very, very complicated issue of what would have happened if we didn't bail them out. Certainly, there had to be consequences. I've heard arguments that we should have let some or all of the companies die. I've also heard the one that I thought was most convincing was whatever we did, we had to seize these companies, fire everybody involved, put a whole bunch of them in jail, and that was the precondition for bailing everybody out. I mean, they had to correct the problem rather than just throw a whole bunch of money at it. But you know, these companies are now so big that certainly it would have caused a big systemic disruption if we had allowed them all to collapse. I mean, everybody with an AIG insurance policy would have been left holding the bag, and the people have been paying into their annuities for their whole lives, and now they're broke. It's hard to say what the consequences would have been.
Well, when you talk about them not going to jail, they don't go to jail, they get promoted.
Right. Yeah, no, it's the opposite.
People then get promoted to being in the government and head of the Treasury, like Bernanke.
Yeah, no, absolutely. I mean, you know, not only are they not going to jail, but they're getting promoted and getting $1 billion. Yeah, no, it's kind of upside down, certainly. All right, well, yes, sir.
Well, then what role does politics play in that? I mean, because I feel like there was a push in the Obama administration to do that kind of nationalization of the banks, but there was such a large blowback from the right and the socialist sort of thing. I mean, what role does politics play in those kind of decision-making process?
Well, you know, to me, all of this stuff is basically a crime story, and the politics are really an element of the crime, I think. In the case of Obama, actually that's not true. When he got elected, the first thing he did was bring in all the same people who were in the Clinton White House who were personally responsible for pushing through all these deregulatory actions. They were all people who were connected to Bob Rubin, who pushed through those two laws, the repeal of the Glass-Steagall Act and the Commodities Futures Modernization Act. And their plan was, we're going to save the banks, and then the implication was that they were then going to kickstart the economy. But they never seriously talked. There were only a couple of people, like Paul Volcker, who were in the Obama White House, but he didn't have any responsibility. Whoever talked about doing any serious nationalization or anything like that. You know, that to me was I really liked Barack Obama. I covered him in the campaign trail. I was tremendously impressed by him. But everybody I talked to on Wall Street says the same thing, that when the economy blew up in 2008 and when he got elected with this big mandate, that should have been the teaching moment. That should have been the moment when this man with such incredible communication skills should have stood up and explained to the whole country, look, this is what happened to you in the last 10 years. Here are the people who are responsible. Here's what we have to do. And they didn't do that. Instead, he went and he took care of the people who were his biggest campaign contributors. And Goldman Sachs was Barack Obama's #1 private campaign contributor. And they took care of them first, and they worried about everybody else next. And I think it was just really disappointing. Anyway, thank you so much for having me here today. I really appreciate it.